Greetings. Now, let's discuss the automotive industry's future. It's no secret that as the adoption of EVs approaches, legacy automakers like Ford and GM are having difficulty. You may have seen the headlines where the CEO of Ford admits that he's shocked by the rate at which EV adoption is happening and that Tesla has crashed before famous money manager Cathie Wood, who has always been devoted to Tesla, recently changed her position on legacy automaker GM dramatically, which surprised a lot of us in an unexpected turn of events. Following a shift in Wood's perspective towards GM and DM's recent difficulties, Cathie Wood's ARK Investment Management has made an investment in GM. The opinions of the industry will undoubtedly be greatly impacted for years to come by the success or failure of Wood's new role at GM. This video will discuss the significance of Wood's prediction, its implications for the larger car industry, and how Tesla's recent price cuts fit into the image, but hit the like and subscribe buttons first before we continue. Remember to use that notification bell as well. According to Wood, by 2025, Tesla's stock might rise to an incredible $3,000. In addition to being astounding, this prediction sheds insight on the difficulties that established automakers like Ford and GM may encounter in the years to come as they attempt to compete with the younger, more creative businesses. This forecast stands in sharp contrast to other experts' more optimistic assessments, such Morningstar's. David Witston stated as much in a recent interview with Sandy Munro. He believes that GM stock has a reasonable value of $68. Jim Farley, the CEO of Ford, acknowledged that the business has lagged behind in terms of EVs. Farley stated that he wished to discuss Henry Ford's success in winning the world by producing an affordable car for all people, and how Ford is currently attempting to imitate this tactic in order to navigate the current market trends in China. The world's largest market, where digital EVs products are becoming more and more popular, with exports to nations like the Netherlands and Norway. According to Farley, it's critical to understand that providing goods at a range of price points, rather than only luxury goods from the 1970s, will be necessary for success. According to Farley, he saw GM's market share plummet from 60 to almost nothing, while Toyota, who had no market share at first, raced to the top by making the cars that consumers want. Farley believes that the best course of action is to take the market as a whole and not just a small segment of it into account. Ford, on the other hand, found that their strength is in the pickup truck industry and that they could compete in the sedan and hatchback markets despite struggling with their business in Europe. With Maverick, they concentrate on markets where we have a deep understanding of the consumer to make sure our innovations are well received. Although Ford should be proud of its 95 electric advance, Farley acknowledged that the company is currently in second place, just behind Tesla with a meager 6.2% of the EV market share. Despite Cassie's skepticism, ARK Investment Management has acquired over 150,000 shares of General Motors DM for its autonomous technology and robotics fund. ARK Wood has previously questioned traditional automakers' capacity to stay up with innovation, so this purchase marks a substantial change in her viewpoint. This action follows an interview with Yahoo Finance in which Wood's team met with General Motors CEO Mary Barra to talk about the company's ambitions for electric vehicles. The findings show that ARK was thinking about investing in GM and was not ruling it out. The choice to invest in GM is noteworthy because it demonstrates that even a well-known stock picker, recognized for our wagers on swiftly expanding technology businesses, is acknowledging the potential of legacy manufacturers and the quickly changing auto sector. It also shows that GM's initiatives in the areas of autonomous technology and electric cars are being observed and may eventually pay off. Woods' investment in GM is encouraging for the business as well as the larger auto sector. It suggests that established automakers can change with the times and still be competitive, particularly in fields like autonomous driving and electrified cars. It also emphasizes the possibility of cooperation between more recent, creative businesses like Tesla and established automakers. The action taken by ARK Investment Management serves as a further reminder that stock market investment involves more than just choosing winners, it also requires being receptive to fresh ideas and viewpoints. According to Cathie, investors should be open-minded and take a variety of things into account when making investment decisions as the auto industry continues to change. Recent price reductions from Tesla present a challenge for rival automakers trying to stay competitive rather than a danger to the brand. Wood thinks that Tesla's cost leadership and battery technology are to blame for these price reductions, and that in order for other manufacturers to stay in the race and prevent losses, they too must adopt this technology. As rival manufacturers struggle to stay up with Tesla's pricing, these price reductions are not a sign of weakness for Tesla but rather a calculated move that will likely improve its position in the market. The company will profit from spreading fixed costs and negotiating better terms with suppliers, as well as maintain its market share growth and reach. Economies of scale have the potential to give Tesla a market edge. By increasing the production of electric vehicles, the corporation may use price as a tool to draw in more customers and increase its market share. More sales volume may follow, which would enable Tesla to take advantage of even larger economies of scale and solidify its place in the market. Additionally, when Tesla's manufacturing volume rises, it will be able to invest more in R&D to further improve its products and create new strategies that will increase its competitiveness even more. Advantage: increasing the difficulty for rival automakers to overtake. Prognosis for Cathie regarding Tesla's latest price reductions. Various Wall Street experts have differing opinions. They fear that these price cuts would negatively affect the company's profit margins and eventually damage its brand value. Certain observers contend that Tesla's brand is founded on the idea of exclusivity and luxury, which is vulnerable to being undermined by more affordable models. Critics also point out that rising supply chain and battery manufacturing expenses may limit Tesla's capacity to reduce prices going forward. Supporters of Tesla, however, contend that the business will be able to maintain its profits while lowering prices due to its cost leadership, advancements in battery technology, and economies of scale. Additionally, they think that by lowering prices, the business will be able to increase its market share and carry on innovating in the EV industry. Indeed, one of the reasons Cathie believes conventional automakers are in difficulty is that they have been hesitant to adopt new technologies, especially electric vehicles. In contrast, many legacy automakers have been reluctant to invest in EVs and have continued to focus on gas-powered cars, which has put them at a disadvantage in the rapidly evolving automotive industry. One reason for this slow adoption of new technologies is the complex and capital-intensive nature of the automotive industry. Tesla has been a leader in this area, investing heavily in EV technology and developing high-quality affordable electric cars that have gained popularity among consumers. Legacy automakers may be hesitant to invest in EVs due to concerns about the high cost of battery technology and the lack of charging infrastructure, but as consumer demand for EVs continues to grow, they are starting to invest more heavily in EV technology. Many have announced plans to launch new electric models and to phase out petrol-powered cars over the coming years, though they may still have some catching up to do in terms of innovation. Legacy automakers have long-standing relationships with the fact that legacy automakers are starting to realize how crucial it is to prepare for new technologies in order to remain competitive in the market is another important element that Wood feels is causing legacy automakers to confront difficulties. Emerging firms in the sector, like Tesla, Rivian, and Lucid Motors, are heavily invested in and committed to creating electric cars. These businesses are upending the established car industry and putting legacy manufacturers under pressure to change with the times while competing with new entrants. Regulators are also posing difficulties for legacy automakers. Stricter emissions laws are being implemented by governments worldwide, which will make it increasingly challenging for automakers to continue producing gas-powered vehicles concurrently. More investment in TVs is being pushed by regulators, which will put more pressure on legacy automakers who have been sluggish to change to remain competitive in this shifting market. These automakers will need to make significant investments in new technologies and modify their business plans to satisfy both consumer and regulatory demands. If companies wish to stay relevant in the automobile business, they must make significant adjustments to their supply chain, manufacturing procedures, and marketing tactics. This concludes the video. Please hit the like and subscribe buttons if you enjoyed it. We'll see you in the future video.